Hello and welcome to FT Markets. After a torrid start to the year, investors are starting to question the strength and the longevity of the European stock market. We've had a bull run for several years now, but things are starting to look a little difficult. To join us to discuss this today, we have Barry Norris, head of the Argonaut Absolute Return Fund. Thanks for joining us, Barry.
Pleasure.
Now, so you were, back in 2009, so bullish about the market that you took out a billboard ad advertising how confident you were, weren't you?
Well, certainly in 2009, we felt it was a once-in-a-decade opportunity to invest in the asset class. That's been proven to be correct. European stock markets have roughly doubled from that point. But I think the main source of that return, certainly since 2010, has been a re-rating which has been very dependent on global liquidity.
And by re-rating, you mean sort of the price, the valuation which investors are prepared to put on stocks has gone up a lot, rather than the underlying earnings.
Absolutely. So back in 2009, we could see that the global economy was bottoming out, corporate profit margins were very, very low, and as a result, we saw market earnings rebound by about 40% in 2010.
And we can see this in the chart here,
Absolutely.
right, can't we? Sort of the blue columns show the valuation of the market. The red line we've got running across, which has been flat for a long time, that shows expectations for earnings in the year ahead at any moment.
Absolutely.
And then the valuation is that green line.
Yes.
So what happened?
So 2010, 40% rebound in market earnings, obviously regaining some of the aggregate level in 2007 before the downturn. But since 2010, we've seen a flatlining in corporate earnings in Europe. The mix has changed, so in the last 2 or 3 years, we've seen a recovery in domestic Europe, whilst those geared towards emerging markets, commodities, have seen a fall off in earnings. Nevertheless, market earnings as a whole flatlining really for the last 5 years.
So we've had a recovery in stock prices, but not really the underlying profits by the companies.
Absolutely. Valuations have gone up, but corporate profits haven't. And certainly as an equity investor, that makes me a little bit uneasy. I would rather invest in a market where profits are growing rather than just valuations are becoming more expensive.
And I think you've got another chart here which shows sort of what type of investing has worked in the last few years.
Yeah, absolutely. So if we move to this graph here, which basically shows growth investing as an ideology versus value investing as an ideology. So put crudely, a growth manager will invest in high quality companies. Maybe they've got competitive advantages, strong balance sheet, good management, etc., etc. A value manager will look for cheapness.
Yes.
And so since the financial crisis, growth managers have significantly outperformed value managers. We would argue that that is because the market for corporate earnings has been so difficult that the factors that growth managers always look for, i.e. high quality companies, strong balance sheet, free cash flow, high return on equity, have been rewarded more in this cycle than certainly the previous cycle when they did very poorly. Because it's been such a difficult environment for corporate profits in general, and generally the more difficult the economic environment, the more competitive advantage and the more investing in high quality companies is linked to their ability to generate profit growth.
So 7 years ago you were very bullish.
Yeah.
Now is it a question that you just think value is going to come back into focus, or are you negative on the sort of the outlook for the stock market as a whole?
I think the next 6 months at least are going to be very, very tough. This re-rating that we've seen of equities has basically been correlated to bond yields coming down. And if bond yields are no longer coming down because liquidity is being withdrawn, then I think you won't get that re-rating in the equity market.
Great. Thank you very much for joining us, Barry. So it looks like a turbulent start to the year and some very difficult times lie ahead.